Hey traders and investors, it's Serge Berger here. Today I would like to focus on a quick topic that is probably one of the most important topics, however, and also probably the biggest differentiator between investors that consistently make money in the markets and those that basically consistently lose money. And that has to do with understanding that returns in the markets are not linear. In order to understand that, let me give you a quick, very basic chart just of the S&P 500 here over the past, call it the past 12 months or so. And if you look at this closely, you'll note there have been several parts of last year where the market literally didn't do anything, right? So look at this period, for example, right? More or less from March through about May, the market it had a little bit of gyration, but it really didn't do much. Then we slipped into another period in June where the market didn't do anything for a while. Then we had like a multi-day sell-off and a big rally up, and again move into a multi-week sideways pattern, right? And then look at this now. The most prominently, we've had a much wider range, but still the market's not doing anything, right? So what this tells you is that if you are nervously uh, running after this market on a day-to-day basis and you really are making trading much more difficult than you should be because trading, uh, you know, as it is defined by a lot of people, is actually an intraday thing. But I think that most folks, A, don't have the time for it to do that properly, B, certainly don't have the personality for it, and C, will find out that a more laid back approach to managing your money is makes a lot more sense and over time certainly will get you much better and certainly more steady results than having to sit in front of your computer all day and nervously clicking around. Or the other case can be made for folks that are just basically holding stuff for a long period of time. And I think I don't have to give you a very difficult example here either. Just look at the S&P 500. Folks that piled into the I have to go back a little bit further here. Folks that piled into the peak in the year 2000. Unfortunately, this one doesn't go back far enough. But basically, the S&P was dead money for 10 plus years. But maybe the QQQs will give that. Let me see. And that's important too because people can really get discouraged, if they hold stuff too long, you get frustrated if you don't see any results, particularly if there's no dividends. So a healthy medium here, is probably the best approach for most personalities. And again, what it really does, it helps you, take advantage of the market when it's actually doing something and stay out of it when it's not doing anything, right? Leaving the Nasdaq 100 right here, you can see we're basically just stuck in a range. Yes, there'll always be something to do somewhere else, and that's what we like to look for. But if you're just trying to day trade these markets, a lot of times you'll get chopped around because markets actually tend to go sideways about 80% or let's say 70 to 80% of the time, and that's a little known fact that folks actually don't want to admit to themselves, and certainly your broker doesn't want you to know. So, if this kind of approach is interesting to you, a little bit more laid back, not having to sit in front of your computer all day, go to thesteadytrader.com, have a look at what we offer over there. Otherwise, you got any questions, you can always hit me up on Twitter. My Twitter handle is steadytrader, and I'll see you in the next video.